Hey there, hello, this is Lynette. Welcome to my discussions on partnership accounting. I have a few goals that I'd like to cover in this pencast. The first thing I'd like to discuss is a basic overview on the topic of partnerships. A little bit about how they're set up and some legal ramifications of this type of entity. And then I'd like to talk about some basic partnership accounting. The good news is, for the most part, nothing changes when you do accounting for a partnership. A little bit, but not much. And then finally, I want to look at the entries that you make to establish a partnership, or actually start demonstrating the accounting for partnerships. That ought to be enough to make this plenty long, so let's get started then. As you've no doubt read in your text by now, aren't I an optimist? I know you read. As you've no doubt read in your text by now, partnerships are really easy to set up. All you need is a couple of people, a plan, something to do, and an agreement to work together. The partnership agreement should be in writing. A lot can go right and a lot can go wrong, but you should have a plan on how it's going to go. This is not a formal requirement, but it really should be in writing. You would want to cover the who, what, where, and when of the partnership. Where you're going to live, what you're going to do, what's your product going to be, that kind of stuff. You should cover how you're going to split income, if you have some. And just as importantly, how you're going to split losses. You should discuss procedures for admitting new partners. And you should probably talk about what you're going to do with the withdrawals of assets. How much money can each one of you take out? And what happens when a partner leaves? How's that going to go down? And finally, what about when you liquidate or end the partnership? All of these things should be included in writing in the written partnership agreement so that there are no surprises. There's some definite pros to partnership. The first one we've already mentioned. It's really easy to get into it. All you need to do is have partners agree to what they want to do and how they're going to do it. They have mutual agency. Sometimes you might wonder if that's a benefit or if that's maybe one of the cons of a partnership. Mutual agency means that one partner, when working within the bounds of the partnership, combine the other partner. You have unlimited liability. What does that mean? Well, if you get in a spot, the partnership goes broke, your creditors can go after the partnership or each of the partners. They're going to go after who they think has the deepest pocket. Some other pros are you don't pay taxes. How about that? You still have to file a partnership tax return, but you don't. It's more of a reporting return. It's like a W-2 sort of. You have to report what you've made, but you don't have to pay taxes on partnership income. Some of the cons of a partnership, I'm going to stick unlimited liability down here too. What if you get into partnership with a schmuck and they leave you holding the bag? So unlimited liability can also be a con. I've gotten another pro. It allows you to have more capital. You have more partners, you have more access to capital and ideas. A con, you have the personalities of the partners to deal with. Things are more complicated than the sole proprietor. And partnerships have a limited life. That's another con. Partnership is an entity, and the accounting for the partnership is very similar to the accounting for other entities. But when a partner comes in, a new partner comes in, or a new partner exits, the partnership dissolves. So there's a dissolve when there's a change in partners. It might just be the life of the partnership dissolves, and you start a new partnership and go forward as a changed entity, so your customers would never know. But a change in partners, it's the life of a partnership. It's legal life. So, there's also several types of partnerships. You can read in your book what they might be. Oh, that's just a brief overview of partnerships. Now I want to get down to some basic partnership accounting. And there's some good news here. It's almost exactly the same as for sole proprietors. Everything that you've learned to date about accounting for sole proprietors still applies to partnerships. The entries to establish the partnership are the same. Just like with the sole proprietor, partners bring in assets and you set them up. Entries to record revenue are still using realization principle. They're the same. You record revenue when it's earned. All the entries you learn to record expenses and sales of inventory, all of that, using the matching principle. They're all the same. Closing entries are the same. They're still the same for. You have to split income a little different. We haven't had to do that before. So we have to learn to split income, but other than that, closing entries are the same. And for the most part, financial statements are the same. There's just more capital accounts involved. One change is to the balance sheet equation. When we were doing sole proprietors, it was assets equals liabilities plus owner's equity. And that's going to change a little bit now. It's going to be assets equals liabilities, and guess what? Plus partners equity. There's more than one capital account. Really, that's about it. So, although some entries are expanding, the entry to establish partnerships, there are more partners. You have to split income a little bit differently. And the financial statement of changes in owner's equity, changes to partner's equity. They're a little different, but everything you've learned still applies. For the most part, there are just more people involved. I'm going to give you a little example of what I mean about more people involved by looking at how closing entries are the same and how they're different. You recall we have 4 closing entries. The first closing entry is supposed to close revenue. The second closing entry is supposed to close expenses. The third closing entry is supposed to close income summary. And the fourth closing entry closes draws. Hopefully this all sounds, or withdrawals. Hopefully this all sounds familiar from 1110, first semester of accounting. Remember, revenue has a credit balance, so we debit revenue. And we put all of that into an account called income summary. Income summary is our temporary account where we facilitate the closing process. We also close all expenses. You debit income summary because expenses have a debit balance, and you credit the individual expense accounts. And this seals them and transfers their balance to income summary. Income summary will change. Assuming you do have income, it will have a debit balance, and so, or credit balance, so you'll have to debit it. So you'll debit income summary, and you'll split it between, let's say we have 2 partners. You'll split it between both partners, and we'll talk about how you split income down the road a little bit here. And then the entry to close draws accounts changes too, because now we have more than one partner. In our case, we have 2. Draws take capital down, so we'll decrease the partnerships accounts by their individual draws. And we'll keep track of their draws separately, so the amount that A withdraws is in an account for A, and the amount that B withdraws is in an account for B. Because if you're A, you don't want to drop your balance for B's draws. And if you're B, you don't want to drop your balance for A's. So as you can see, they're mostly the same.